Great. Hello, everyone. Thank you so much for joining us. This is a second part of our day-long conference, and we appreciate you all joining us. This year's session is sort of focused on intelligently investing in the blockchain space, and we know we have a lot of family offices and wealth advisors and high net worth individuals on the call. So you'll hear a lot of the agenda from here helps you really understand different investment thesis in the blockchain space and how to think about investing. And you'll also hear from some of the absolute top VCs in the space this afternoon. We had some this morning. This afternoon, we have several from the US and then also from Asia. Some of our Asian participants are connecting in. And we also will have Topher sort of give a foundation for the industry context and talk about different investment strategies. So many of you know blockchain co-investors very well, and Matthew and I, the co-founders, and Mitch Meshigan, our partner, but many of you are new to the firm. So I thought I would just give a few minutes on the genesis story for blockchain co-investors and how we came to be here today. Back in 2013, Matthew and I started investing significantly our own money in the blockchain space. We had both spent a lot of our careers in financial services, working in consulting and also as executives in the space, and also then as investors in the space. And we had meetings with a lot of the early blockchain entrepreneurs who were exceptionally smart, bright people, very excited about the breakthrough of the Satoshi white paper, and with incredibly big visions and exciting plans for the space. And as with most people, it's very hard to get our heads around at first, but after about 25 or 30 meetings, it clicked for both of us that this was a really important new technology and part of the innovation economy that over the next 20 years would create really the next generation of our digital economy and digital society by bringing to bear better security, a solve for digital identity, and replaced a lot of the creaky, antiquated payment rails and sort of pretty old structures in legacy financial services with a new tech stack that was more fit for purpose in a fully digital economy. So we started investing our own money quite heavily. We had been investing in early stage tech for a long time, and we knew it was very important to be diversified and to be partnered and invest alongside with the absolute best investors in the space. So we took our time to find the smartest and most capable specialist venture capital firms in the sector, which at the time, there were few. They were very small. They were getting started, but we got to know many of them. And in many cases, we were in their first funds. In some cases, we were their first check. And we sort of chose that as our investment strategy back in 2013. Fast forward a few years, a lot of people in our networks, colleagues, partners, friends were coming to us and for sort of education about the space, trying to understand what we were doing. And we were very happy to do that. And we referred them to some of the VCs that we were invested in. But it became clear that it's hard for a lot of people to access this sector, even if you believe, as we do, that it's exceptionally important. It's a huge value creation space, and it's just getting started. It's a very hard space to access. A lot of people started by buying crypto, or they had a friend of a friend who was had a project that they were investing in. And so we sent them to the best VCs in the space, but many of those firms by this time had, $1 million, or in some cases even $5 million minimum tickets. And even that wasn't a solution for a lot of people. So Matthew and I, in about 2016, we decided to create an institutional quality platform for people who were at high net worth, family offices, wealth advisors, for people like that who are interested in accessing blockchain investing to sort of safely and intelligently invest in the space. And we have both been in the investment world. I was the chief financial officer at BGI, BlackRock. We managed $1 trillion of pension fund assets at the time. I also ran a private equity firm that invested in banks. Matthew was at Monitor Ventures and was a GP at Keiretsu Capital. So we understood investing, and we wanted to build a really sort of top class firm that helped people invest smartly and in a high quality way. So our core strategies are fund of funds, which means that with one check to us, you will be invested in some of the best VC funds in the world and through them into their portfolios. So with one check, you get access to 300 or 400 of the leading blockchain-based companies and projects of that vintage. We also have been very heavy on education. And those of you who know us, we do weekly newsletters on lots of topics. We have great resources on our website. We have our BlockTalk AI daily podcast, and we're always happy to spend time with any of our investors or prospects or people who are interested on a Zoom call or in person to catch up on the space. We also are global. 50% of our investments are in the US, about a quarter in Asia and a quarter in Europe. And we keep investing. So we always have an open fund. So, if there's a particular year when the next Google has its seed round, then, we're through our VCs more likely to be in that round. So we've tried to build a really great platform. We now have positions in 1,500 of the best blockchain companies and projects globally. And we're up to our 7th fund. We have a core fund-to-fund platform. And then we also have, for many of our investors who are interested, we also have a fund that is later stage growth fund. And we also do special purpose vehicles from time to time in later stage companies that are the emerging unicorns in the space that our VCs are extremely interested in, and that we think it's worth partnering with directly and putting more capital to work. So enough said about that, but I just wanted to give those of you who are new to our firm a little bit of background on how we started and what we're doing now. We feel very privileged to be part of this ecosystem. We work very closely with the VCs that we invest in, and also with the emerging unicorns and leading companies in the space. We serve on the boards of several of them. We help their teams find new C-suite members or board members. We sometimes run strategy sessions for the teams to help them refine what they're focused on, and many other ways that we try and be helpful. So we would be very happy to follow up with anyone who's interested in learning more. But now I'm going to launch us into our afternoon session. And we're starting with my colleague, Topher Nelson, who heads our research, who will give you a sort of macro perspective on the sector. Thanks, Topher.
Thanks, Allison. And I'll just put up a quick deck on the screen here. And it is great to see everyone on the line. I know I haven't met some of you yet, but you are certainly in the right place here. My name is Topher Nelson, and I'm the head of digital asset research at Blockchain Co-Investors. And we have a really super all-star lineup for the afternoon and evening session today. But before we get into it, we wanted to kick off by running through some of the key investment strategies for blockchain and crypto and really break down this asset class because, as Mitch said earlier, and I think Chris Maurice at Yellow Card said again, blockchain isn't a monolith. There are actually 6 distinct asset classes, and each is a slightly different beast with its own best practices and pitfalls to avoid. So I'll do a short presentation covering exactly that, including a bit on what is blockchain, why it's important and why you should care, and how you can get access to all of these 6 distinct asset classes we'll discuss. And then we'll get into some of the great speakers we have lined up for you in a few minutes. But before I dive in, I do have to show you this disclaimer. Of course, we'll be discussing investment strategies today at a very high level, but nothing here today should be construed as investment advice or solicitation. This webinar, to be clear, is purely for educational purposes.
Topher, I don't think we can see your slides.
Well, let me update that then. How about now?
Yes, now we can if you go to full screen. There you go.
Brilliant, yeah. So now that you can see what I'm looking at, here's the agenda for today. And first, we'll just briefly go over, as I said, why you should care, why you should want to invest in blockchain and crypto. And so we'll start right there at the basics. Then we'll discuss the 6 asset classes and how strategies shift for public versus private investments, early versus late, and even equity versus token investments, which is critical to our industry. Third, we'll touch on some of the approaches and strategies we employ, as well as some of the strategies that we're not involved in, but may be of interest to you. And there are other speakers online today who specialize in each of those. And finally, we'll talk about why this matters today. So where are we in the development of blockchain? What's happening in the US now? And why should you potentially consider leaning in today? So first, what is blockchain technology? We'll keep it pretty high level, but essentially, blockchains allow us to create fully digital ledgers in a distributed, decentralized manner, which essentially, is very simple, as Mitch explained. It's just keeping shared records in a natively digital and secure way. And this is a quite simple idea, in fact, but it's actually a massive, massive technological unlock, which basically allows you to have peer-to-peer transactions or interactions of any type on the internet natively. And that's so massive because until now, you've had to do that through centralized parties, like a bank if you're sending money, or even a social media company if you want to connect with a friend online. But when you unlock real peer-to-peer interactions, that opens up massive new use cases, from payments to remittances, like you see on the right-hand side here, all the way to tokenization, capital coordination, gaming, storage, identity, and even things like decentralized science or DeSci. But ultimately, you can start to see here how all transactions of all types in the digital economy could eventually settle on blockchains. And that's exactly what our thesis was and what we were founded on more than 10 years ago, that just as the internet digitalized communications and content, blockchain will allow for the digitalization of commerce and finance. So we see blockchains as critical infrastructure technology, which unlocks the digitalization of monies, commodities, and assets. And this is even more important today than ever before, particularly with the rise of artificial intelligence recently. And we get the questions about this a lot, so I'll answer briefly on AI. AI's impact on the internet will be enormous. Obviously, I think everyone knows that. But the internet today has a handful of problems. It's insecure. It has no system of identity. It's overly concentrated with too many single points of failure. There's no way to make native payments across the internet. There's no ownership primitives. And because of all those insecurities in the near term, the rise of AI will make all of these networks more susceptible to hack and attack. And we're already starting to see this, which means many more phishing scams, many more bank hacks and financial crimes of all sorts. And because software like AI scales so well, it will be on a scale we're really not prepared for. All of which, in fact, makes blockchain more critical. So we see the interaction of, or the intersection, I should say, of fintech, blockchain, and also AI as one of the most exciting confluences, and we're calling this area digital finance, which you can see here on the chart. We think blockchain is obviously a critical component of unlocking digital finance because it allows us to upgrade the back end of the entire world financial structure. Fintech, you can think of as the front end, which makes consumer apps easy to use. And this is like your Venmos and your PayPals, or if you're in the UK, a Monzo, or maybe you're international, that would be like a Revolut. But those apps, as great as their front ends are and as easy as they are to use for consumers, we heard this from Chris Maurice at Yellow Card, they didn't do anything to innovate or improve on the back end. So on the back end of most of these fintech apps, you're still dealing with the same antiquated analog financial back end system. And fintechs in the last 10, 15, 20 years have really sort of just put a nice wrapper over it so end users don't see it, kind of like a Band-Aid. Blockchain, on the other hand, allows you to actually completely replace that back end with a natively digital and secure financial infrastructure built for the internet age, where monies, commodities, and assets can be instantaneously transferred across the internet, peer-to-peer, at almost no cost and in a fraction of the time. And as I said, we think eventually all financial transactions will be settled on blockchain infrastructure. Now we have the rise of AI, which will make many of our existing financial networks much more vulnerable to attack in the near term, like I said. But on the flip side, it will also likely make them easier to use. And with things like chat-style front ends, we can start to see a real path to things like true robo-advisors, sophisticated investment strategies that automatically rebalance themselves, and even novel ways to distribute things like computation and deal with identity on the internet. So the confluence of these three areas is what we call digital finance, and it's what we're really excited about, and blockchain infrastructure is really critical in unlocking it. So as I mentioned earlier, blockchain technology is not a monolith. In fact, there are 6 distinct asset classes. And this is how we like to think about the investment landscape here. And the news media typically obscures or misses these distinctions altogether, so it's critical to understand. First and foremost, you can think of this as broken down into private investments and public investments. So you have investments that are not available to the public, they're private, only available to accredited investors in the US or sometimes qualified purchasers. Those are generally earlier investments and riskier. Eventually, they mature, they have a going public event, and this is true for both tokens and equities. Once they're public, they're generally available and anyone can buy them. So again, they start very early, they move to the mid to late stage, and then go public. And second, you have both tokens and equity, which is totally unique to our sector. You have traditional equities like the ones we know and use already every day. Just think of your brokerage, your Fidelity, your Charles Schwab. But in this industry, we also have tokens, which are a completely novel form of ownership. And they're one of the reasons this space is potentially so interesting from both a technological perspective in terms of the use cases they can accomplish, but also from an investment perspective in terms of attractive return profiles. But they do come with higher risk. It is a nascent asset class with some regulatory uncertainty still, and also far less market structure, or sort of market norms or norms built around disclosure and whatnot. So there are pitfalls to be aware of in both approaches, but when you're thinking about investing in the space, I think this really is the money slide, and Mitch said it earlier, and I'll say it again. You really have to think about what the best strategies are in each bucket. So if I'm investing early, you have a higher rate of failure, more illiquidity. If I'm investing at the mid or late stage, these companies are a bit bigger. Maybe these token projects are a bit bigger, but there's ideally revenue and a compelling product. And then at the public stage, ideally there's less risk involved, it's more liquid, and you have more information. But that's not always the case. And again, just to double click on this tokens versus equity, because this is important to understand. Most everyone knows and is familiar with equity in some way. This is your traditional corporate structure where equity typically gives you ownership rights, voting rights, and a lien basically on cash flows or economic increases of the business. Normally in jurisdictions like Delaware or the US, And these are fairly standardized instruments. Again, this is all the stocks you can trade on the NASDAQ, the New York Stock Exchange, etc. Tokens, on the other hand, are a new form of ownership, as I said. And broadly, a token represents a unit of account on a blockchain or a public ledger. And a token can represent many different things, and this is what's unique, including equity and voting rights, like you see with typical equities and ownership rights. But it can also represent something else entirely. For example, it could be critical to the functioning of an ecosystem, application, or a microeconomy. And you may even need the token to do some sort of task, to purchase storage, to purchase compute. Some tokens accrue cash flows and economic rights to the underlying protocol or network. Others don't. So they have widely varied use cases, and there is much less standardization. So it's key to keep this distinction in mind. And tokens have more of a gray area in the US in terms of their legal structure, although it's already looking like the majority won't be deemed securities, which we'll talk about later, although some have been so far. So there are a handful of different types of tokens, which I'll just double click on briefly. Starting at the top here, you have central bank digital currencies or CBDCs and stablecoins, which both are very much like traditional products. They're essentially digital assets representing dollars, either issued by private institutions in the case of stablecoins, or issued by public institutions like central banks or governments in the case of central bank digital currencies. Next, you have crypto assets, and this is like Bitcoin, which are essentially forms of money, or at least some or most of the characteristics of money, but which are not issued or tied to any nation state or central authority or government. Moving on down, you also have asset-backed tokens. And for example, you could issue a token against something like a money market or gold, have a gold token. And this would be like a lien on a traditional financial product, just in a natively digital form. But then you have a whole host of new types of tokens which really don't map onto trad products at all. And these are things like protocol tokens. For example, Ethereum, where you actually need Ethereum tokens to use the Ethereum network and pay for transaction fees. You also have utility tokens. Again, things like Filecoin, where you need the actual Filecoin token to purchase storage in the Filecoin ecosystem. You have DeFi tokens, which operate in a bit more of a gray area, where some of them have the implication of economic rights based on the revenue of the underlying protocol or network. And sometimes those fee switches may turn on or off at different times or be voted on. Then lastly, you have non-fungible tokens, which are essentially one-of-one tokens that are often used for representing digital collectibles, art, and things like that. But they also have huge potential, not yet tapped in my mind, for things like deeds, certificates, the pink slip for your car, maybe even the title for your home. So that's a lot to handle. You have public versus private, early versus late stage, token versus equity. But what are some of the best practices and how do we think about this as a fund? So first and foremost, at the high level, I'd say we're focused squarely on digital finance. There's a whole lot going on in the world, AI and fintech, broadly life sciences. It's a very exciting innovation time to be in space, but we are squarely focused on the confluence I described earlier in digital finance. We tend to focus on early stage technology investing, emphasizing digital monies, commodities, and assets. We want to back the actual asset technology class and secure broad coverage. It's really important for us to be diversified, and I'll touch on why shortly. At the early stage, it's very difficult to weed through thousands of projects that you could invest in. So part of our strategy is to co-invest with the top investors. Then when projects mature a little more, we selectively follow on and we'll take direct stakes in companies where maybe they have a product, real revenue, sometimes they're even cash flow positive. And that's the part of our business our London partner Mitch leads. And we'll go in when things have been somewhat de-risked and double down on the emerging category leaders. We also invest through downturns, and we've been doing this since 2014 consistently. So we've seen multiple cycles up and down, and we continue to invest through volatility. And in our view, it's very much like early internet investing in this way. if you didn't invest into the downturn following the dot-com boom, you would have actually missed out on a huge, huge range of value capture. And lastly, we aim to be very disciplined and very low cost. So all in all, we focus primarily on these three buckets. In terms of early stage equities, we get that coverage through our fund-to-fund structure. So we invest in, say, 20 different funds in different areas to give us broad diversification. For tokens, we have a dedicated token vehicle, which buys illiquid tokens, and I spend quite a bit of time on that vehicle myself. And finally, we have a mid-stage investing opportunities through both dedicated SPVs, like Allison mentioned, and the mid-stage vehicle, which Mitch leads. And I touched on this earlier and said I would come back, and I'll come back right now on the importance of diversification at the early stage, because venture returns generally follow a power law distribution, and I'll explain this. So on the left-hand side here, the blue line, that's what a normal distribution looks like. And most people are familiar with this. This is like you'd see the distribution of heights in America. Most people are average height, the vast majority, while some are exceedingly tall and some are exceedingly short, but not very many. Earthquakes, though, for example, on the other hand, follow a power law distribution, and that's like what we see in the pink here on the left. Most earthquakes are very small. In fact, the vast majority are, but there's a very small number of much larger earthquakes which carry outsized importance. And venture returns are just like the earthquakes in this way. On the right-hand side here, you can see actual return statistics over time. And this is over a 10-year period, and these are for general venture investments. And this is even more the case, I think, for our industry, which is higher risk and even higher return. And essentially about 65% of investments, i.e. the vast majority, give you almost no return, so less than a 1x. And a very small number of investments will be multi-x fund returners. These will be your 10x, 20x, 50x, even 100x returns. So that's our strategy when it comes to early stage investing, to get that broad diversification. And we believe a portfolio approach like that is the right approach because it's so difficult to pick the winners at the early stage, even for the best. You really need to use power law and the power of portfolio diversification to do that consistently. And we do that by running a very disciplined fund-to-fund investment process. We're looking for the most prolific top blockchain fund investors at the early stage. We want to back about 20 of these in each of our fund-to-funds, and that gives us approximately 300 to 500 underlying portfolio companies with diversification across geography, asset class, and different themes. Then obviously we conduct very rigorous diligence on their operations and investment process. So really that's how we think about the very early stage. But when we invest directly at the mid and late stage, here are our fundamentals, and they're slightly different. We want to be very thematically aligned at the mid and late stage, so we don't go into areas we don't understand or don't know. We're squarely focused on the digitalization of monies, commodities, and assets. We look to back new projects already backed by a syndicate or group of leading investors. At the mid stage, ideally, they already have some product market fit, some revenue, they're growing, maybe they have a really strong management team or an attractive profile, and then you have to start thinking about exits. So could this company legitimately IPO? Who's a natural buyer? Could they tokenize? Have they broken too much regulatory glass? And so on. And this is how we think about our direct investments. So that gives you a bit of a taste on how we approach both the early and mid stage, but there's also public investments, and it's not something we're very active in, but I do want to touch on it, and I will speak with Matt at Bitwise shortly, who is an expert in it. And you'll see here, for accessing public liquid crypto, you have a few options. The first on the left is to simply purchase it yourself. The second is to use exchanges and wallet platforms in the middle here. And the third on the right is a more institutional option, so using hedge funds or pro trader platforms. And for most people just starting out, that middle bucket probably makes the most sense. You want to go what are essentially brokerage firms, places like Coinbase, Kraken, Uphold, and so on, which have some guardrails in place. So not every token in the world is available on those platforms, but they're very easy to use. They have good user interfaces, and they handle the custody, etc. for you. If you're very interested in the technology and really learning how to use it yourself, you can actually access crypto directly yourself and hold everything yourself. You can trade directly, peer-to-peer, even trade natively through decentralized exchanges and manage your own custody and private keys and so on. On the flip side, for a smaller minority, if you're an institutional investor or trader, there are institutional platforms as well, shown on the right here. But another way to get exposure, which I'll be discussing, as I said, shortly with the Bitwise CIO, are the ETFs. And this is a relatively new development in the US. And we now have the proliferation of Bitcoin ETFs, which basically give you Bitcoin exposure wrapped in a traditional equity-like experience. So you don't have to open a new account. You can buy them right in your Schwab, your Fidelity, just like you already do. So why does this matter, and where are we today? Question would be, in my mind, and I get this a lot from investors and conversations I'm having, is, are we too late? Maybe we get that this matters already, but where are we in the blockchain's development? Did we miss the bus? Has it gone 10 years ago? So these are critical questions I'm just going to spend a minute on before we move into the next awesome panel we have today. And the first thing worth noting is that blockchain is very early in its development, very, very early. Compared to the internet, which you see on the left-hand side here, it's actually quite ahead even. The internet did not just spring out of thin air in the late 90s. It actually had about 30, almost 40 years of technical development starting in the 60s. So it had been around for a long time before the 90s. There just wasn't any commercialization. The first kind of commercial app on the internet was Netscape Navigator, or the browser. And that totally opened up the internet and created a sort of Cambrian explosion of innovation. And there aren't even really many new sustainable cash flowing business models that we see until the late 2000s and 2010s, when you start to see the Googles and Facebooks of the world emerge. So there's really even 20 years of commercialization before we get to the behemoth companies that exist and dominate the internet today. Then we have mobile and cloud, and the rest is sort of history. And everyone now realizes the internet was one of the biggest value creation events ever, if not the. But we're 60 to 70 years in. Blockchain, on the other hand, the Bitcoin white paper was only released in 2008. We've already become a $3 trillion asset class in about 16 years. The Ethereum white paper was released in 2013. Now Ethereum's market cap is over $200 billion. The first stablecoins emerged in 2014. Stablecoins already, about 10 years later, are processing trillions of dollars of volume around the world. So blockchain has evolved really fast. But if we're talking about upgrading the world's financial infrastructure, it's a multi-year transition. That's only just starting. So the way we see it, if you invest today, you still are early. We do have hundreds of millions of users, trillions of dollars of payments being settled on stablecoins, and Bitcoin is now a globally important macro asset. But this is still quite early. Although, as early as it is, just after 15 years, we are already becoming a recognized part of the financial system, which is really remarkable, especially considering in 2008, this is not that long ago at all, there was nothing. No crypto, no anything. And today, the US government is establishing a crypto reserve. I mean, that's monumental. Institutions are also buying in mass now, like BlackRock launching money market fund with one of our portfolio companies, Securitize, or Visa getting into the stablecoin business. We do a whole report on this biannually, so I recommend checking that out on our website. But the institutions are investing. The protocol development is way ahead. The infrastructure has been developed, and blockchains are starting to scale. So Solana, for example, is creating a massive amount of throughput, which really competes with the NASDAQs of the world. And you can start to see the way things are heading, which is that we believe all financial activity will eventually settle on blockchain-based rails. And a really important part of this story is the shifting regulatory landscape in the US. The remarkable shift in the US regulatory apparatus following the election and the inauguration could not be more positive for our industry and for our investments. We now essentially have a blessing from the top of the industry with things like the strategic Bitcoin reserve, Congress working to pass stablecoin legislation and a market structure bill, and those have been incredibly bipartisan efforts to create regulatory structure. We also have ETF proposals coming in for additional tokens beyond Bitcoin and Ethereum. And many of the antiquated regulations that were stifling the industry have since been rescinded or are being rescinded. And prominent cases like the legal case against Coinbase and Kraken have already been dropped. So the industry in 15 years really made such substantial progress with the world's largest capital and financial market essentially sitting effectively on the sideline completely. So for us, the tee up today really couldn't be more positive. And it's really remarkable to say that still, because in terms of performance, this has been basically the best performing asset class of all time already. Public liquid crypto and even blockchain equities have shown remarkable performance. And if you use Bitcoin as kind of an S&P 500 of the industry, it's been the top performing asset globally for 10 of the past 13 years. So the track record has been really great so far, and the setup today continues to be exceedingly positive. So we think for investors out there who aren't yet aware, this really warrants a closer look. It's not something we think you can afford to ignore anymore, and it's not just for technologists. It's going to be fundamental to the global financial system, and it already is becoming so. So that's why we wanted to set the stage with this presentation and let you know why you should care, how we think about the investable landscape, where we are today, and some of the things we think the future holds. So we really urge you to dig in, and you're in great hands today because we have an absolutely fantastic lineup of really industry heavyweights who specialize in each of the buckets we looked at. And so with that, Matthew, I'll hand it back to you to briefly cover the next poll or topic.
Thanks a lot, Topher, for taking us through all of that. I can see that Nick and Matt have already joined. Nick Tamano will be with us, I'm sure, momentarily as well. Matt and Nick, I had a little bit of house cleaning I was just going to do before you joined. If you don't mind, can you just give me 1 second? But we'll be straight into your session momentarily. Thank you, Alison and Topher, for kicking off the afternoon. I do have to repeat a few disclaimers and points just as we go into this. This is an open public webinar event. While most of the people who are attending are accredited investors, family offices, multifamily offices, and so on, we're well aware that not everyone on this listening in is. So this is not a solicitation environment. This is an educational only environment. And you should not be making any investment decisions on anything that you hear today. This is to educate you and get you up to speed. And then hopefully you'll be able to do the due diligence you need to do to make your own decisions. Something else I need to also call out is that whilst we are an asset manager, we ourselves cannot go into the detail of our investment strategies. We've had a few people ask for more information, but you have to reach out to us to receive detail about our investment strategies. In terms of this afternoon, you already saw Matt and Nick arrive, but just let me give you the headlines. I mean, we have a remarkable afternoon. We're very fortunate to have 6 general partners from the world's leading blockchain venture capital firms here. And we've asked them each to focus on their investment strategies and how they gain access to the investments they make. For full disclosure, we are investors in all of the funds that you'll hear from today. We then have 4 CEOs of tokenized blockchain projects, all at the intersection of AI and blockchain. And again, for full disclosure, we're an investor in all 4 of those projects, but you'll be hearing from them, Gravity, Galaxy, T54, and Compute Labs. And we know by the end of today, we'll be joined by the Asian time zone community. And so we'll have to restate some of the things I've just said. So having said all of that, we're about 3 minutes. We're running about 3 minutes fast. Nick and Matt are here, and we should use their time. But also, Nick Tamano isn't yet here. So, Kim, maybe you could give him a quick ping, and I will introduce Nick and Matt. So, Nick and Matt, if you want to come on video again, sorry for that. There they are. And Nick may have gone on hold. So I think what we should probably do, Matt, let me give you back about 3 minutes, and we'll resume as soon as Nick Tamano joins. Is that okay, Matt?
Perfect.
Okay. And Kim, maybe you could pull up a couple of the polls whilst we wait for Nick Tamano. So I think we're going to redo the polls. In fact, someone asked to see them again. So let's go with poll number 1. And these polls are intended to allow us to fine-tune the event and to understand the audience. And we ran them in the morning. Literally, this should take no time at all for you to click on, unless you're driving or doing something else that makes it hard for you to use your phone. So this is simply about why you're interested in blockchain investing. And as this morning, most of you are interested in all of those themes. So you believe in the transformation of finance. You can see that distributed, decentralized Web3 communities are important. You want to support the next generation of entrepreneurs. And of course, you want to make money as an investor in the space. So no particular surprises, but it's good to hear. And it's also interesting to see roughly the equal balance on the sub-issues. So I'm going to leave that up just for a moment.